Hey everyone, welcome back. Today we're taking a deep dive into the world of cryptocurrency.
Oh, interesting.
Yeah, we'll be exploring what it is, how it works, and why it should matter to you, especially when it comes to your retirement and asset protection.
It's a fascinating topic, especially given the current political climate.
Right, there's a lot of buzz about how cryptocurrency might be impacted by government policies, particularly with the Trump administration. We'll definitely delve into those concerns.
Yeah, it's important to understand the fundamentals first.
Absolutely. So let's start with the basics. We're talking about digital currencies, right? And the most famous one is Bitcoin.
Exactly. Bitcoin is like the pioneer of cryptocurrencies. What sets it apart is its decentralized nature.
Okay.
Unlike traditional currencies, there's no central bank or government controlling it.
So no Federal Reserve telling the odds.
Nope.
That's a pretty radical concept.
It is. It operates on a network of users, all connected through a technology called a blockchain. Think of it as a public digital ledger that records every single Bitcoin transaction ever made.
Okay, blockchain. That word pops up everywhere these days. But honestly, it still sounds a bit like something out of a sci-fi movie.
It might sound futuristic, but it's actually a pretty simple concept. Imagine a giant shared spreadsheet that everyone has access to.
Okay.
This spreadsheet records every Bitcoin transaction, and it's constantly being updated and verified by a network of computers.
So everyone has a copy of this spreadsheet. How does that make it secure?
That's the beauty of it. Because the ledger is distributed across so many computers, it's virtually impossible to hack or tamper with it.
I see.
To alter one record, you'd have to alter every single copy on the network.
Ah, that makes sense. So it's like a giant tamper-proof accounting system for Bitcoin.
Precisely. And that's what gives Bitcoin its security and trustworthiness.
Okay, so we've got this digital currency that's decentralized and secured by this blockchain technology.
Right.
But how is Bitcoin actually created? Where does it come from?
That's where the process of mining comes in. Powerful computers solve complex math problems to validate transactions and add them to the blockchain. It's like a global competition to solve these puzzles, and the winners get rewarded with newly created Bitcoins.
So these miners are basically the ones generating new Bitcoin.
Exactly, and that's how new Bitcoin enters the system. It's a very clever way to incentivize people to maintain the network.
Wow, that's really interesting. But there's one thing I still don't get. How does Bitcoin actually gain value? It's not like there's a physical asset backing it up, like gold or a government guarantee.
You're right. Unlike traditional assets, Bitcoin's value is determined solely by supply and demand. There will only ever be 21 million Bitcoins in existence. This limited supply, coupled with growing demand, has driven up its price significantly over the years.
Okay, so it's all about scarcity and market forces.
Yeah.
But that also means it can be pretty volatile, right? We've all heard stories about Bitcoin's price going up and down like a roller coaster.
Absolutely. Volatility is one of the key characteristics of cryptocurrency, and that's something to consider carefully, especially when thinking about your retirement funds.
Right. Retirement is all about stability and security. And with all this talk about price swings, Bitcoin seems anything but stable.
You're not wrong. Those dramatic price swings can lead to significant gains, but also significant losses. And for retirement planning, that kind of uncertainty can be nerve-wracking.
So what are some of the other risks we should be aware of when it comes to cryptocurrency?
Well, there are concerns about security and scams. And then, as you mentioned earlier, there's the whole issue of potential government involvement and how that might impact the market.
Right. With the potential Trump administration, there's a lot of talk about how he might use cryptocurrency for his own benefit.
That's a valid concern. Some people worry about potential market manipulation, insider influence, and even deregulation that could favor his interests.
This is definitely a deep dive, and we're just getting started. So let's break down these risks one by one, starting with scams. What kind of shady stuff is happening in the crypto world, and how can we avoid getting caught up in it?
The cryptocurrency world, with its relative newness and complexity, can be a breeding ground for scammers looking to take advantage of unsuspecting investors. One of the most common scams you'll encounter is phishing. This is where scammers try to trick you into giving up your private keys or login credentials. They might send you an email that looks like it's from a legitimate cryptocurrency exchange.
Oh, wow.
Or wallet provider.
So they're creating these fake websites or emails that look incredibly real to steal your information?
Yeah.
That's terrifying. How can we spot these phishing attempts?
A good rule of thumb is to be wary of any unsolicited emails or messages asking you to verify your account or reset your password. Always double-check the website address.
Right.
Look for secure connections like HTTPS and a padlock icon in the browser bar.
Okay.
And never click on links from suspicious sources.
That's great advice. It's like the digital equivalent of stranger danger. Don't trust anyone you don't know, especially when it comes to your finances.
Exactly. And speaking of trusting strangers, another common scam is the classic Ponzi scheme.
Oh no, not those get-rich-quick schemes that always end badly.
That's the one. They promise ridiculously high returns with little to no risk. They use funds from new investors to pay off older ones, creating an illusion of success.
It's like a financial house of cards bound to collapse eventually.
Exactly. And when it does, the people at the bottom of the pyramid lose everything. Always remember, if an investment opportunity sounds too good to be true, it probably is.
Right.
Do your research, look for transparency, and be wary of promises that seem too good to be true.
Okay, so we've got phishing scams trying to steal our logins and Ponzi schemes promising unrealistic returns. What other shady tactics should we be on the lookout for?
Another common one is called a pump and dump scheme. This is where hammers artificially inflate the price of a cryptocurrency
Oh, okay.
by spreading false or misleading information, often through social media or online forums.
So they create hype to manipulate the market for their own gain.
Precisely. Once the price is pumped up, they sell their holdings at a profit, leaving unsuspecting investors holding the bag as the price crashes back down.
It's like a classic stock market manipulation tactic, but in the crypto world. How can we avoid falling victim to these pump and dump schemes?
Be wary of sudden price spikes or hype surrounding a particular cryptocurrency, especially if it's not backed by any real-world use cases or solid fundamentals. Research the project thoroughly. Look for a credible team and understand the underlying technology before investing.
So it's all about being informed and not getting caught up in the hype. What about these initial coin offerings or ICOs we hear about?
ICOs can be legitimate ways for new cryptocurrency projects to raise funds, but they can also be ripe for scams. A fake ICO might lure investors with promises of revolutionary technology or sky-high returns.
Right.
The project might not even exist, or the tokens they issue could be worthless.
So basically, they take your money and run. That's a real risk. How can we tell if an ICO is legitimate or a scam?
Thorough research is key. Look for a detailed white paper outlining the project's goals, technology, and team. If you can't find a solid white paper, or if the information is vague or too good to be true, it's best to stay away. Also, check if the ICO is registered with any regulatory bodies and look for independent audits or reviews from reputable sources.
Okay, so the takeaway here is to do your homework before handing over any money to an ICO. It's like investing in any startup. You want to make sure it's the real deal before you bet on its success.
Right.
We've talked a lot about scams, but let's shift gears to security.
Okay.
You mentioned digital wallets earlier. Can you explain what those are and why they're important?
Certainly. When you invest in cryptocurrency, you need a place to store it securely. That's where digital wallets come in. They're essentially digital containers that hold your private keys, which give you access to your cryptocurrency.
So it's like a digital version of your physical wallet where you keep your cash and credit cards.
That's a good analogy. There are different types of wallets, each with varying levels of security. Hot wallets are software-desked and connected to the internet. They're convenient for frequent transactions, but they're also more vulnerable to hacking since they're always online.
So hot wallets are like having your wallet in your pocket, easy to access, but maybe not the safest place to store all your cash.
Exactly. Then we have cold wallets. These are hardware-based, like a physical device,
Right?
and they store your private keys offline. This makes them much more secure as they're not constantly exposed to the internet and its potential threats.
So cold wallets are like having a safe deposit box at the bank, more secure, but not as convenient for daily spending.
That's a perfect comparison. And then there are paper wallets, which are literally your private keys printed on a piece of paper. They're very secure as long as you keep that paper safe.
Oh, wow.
But if you lose it, your funds are gone forever.
Okay, so the type of wallet you choose depends on your needs and risk tolerance. If you're actively trading cryptocurrency, a hot wallet might be more suitable. But if you're holding for the long term, like for retirement, a cold wallet seems like the way to go. What about these exchanges we hear about? Are those the same as wallets?
That's a great question. Cryptocurrency exchanges are platforms where you can buy, sell, and trade cryptocurrencies. They're like the stock market for digital assets. While some exchanges offer wallet services, it's generally not recommended to store large amounts of cryptocurrency on an exchange for extended periods.
Why is that?
Exchanges are prime targets for hackers because they hold vast amounts of cryptocurrency. If an exchange gets hacked, your funds could be at risk. It's a bit like leaving your cash in a busy marketplace.
Right.
It's more vulnerable to theft.
That makes sense. So it's best to transfer your cryptocurrency to a more secure wallet, whether it's a hot wallet for active trading or a cold wallet for long-term holding once you've purchased it on an exchange.
Exactly. Think of exchanges as a temporary stopover for your cryptocurrency, not a permanent residence.
Okay, that's a helpful way to look at it. We've covered scams, wallets, and exchanges. Now, let's talk about the elephant in the room.
Okay.
Government involvement. As we mentioned earlier, there are concerns about how a Trump administration might impact the cryptocurrency market.
Yes, that's a crucial topic to address. Government involvement in cryptocurrency is a double-edged sword. On the one hand, regulation could bring much-needed clarity and stability to the market. It could enhance security, protect investors from scams, and encourage wider adoption by businesses and institutions.
So regulation could actually be a good thing for cryptocurrency.
It certainly has the potential to be.
Yeah.
However, on the other hand, there are concerns about how a Trump administration might approach regulations. Some people worry that he might use his power to favor certain cryptocurrencies or companies over others,
Right.
potentially distorting the market and creating unfair advantages for his allies.
That sounds like a real risk, especially given his history of using his position for personal gain and favoring his inner circle.
Exactly. And then there's the issue of market manipulation. We've already seen how pump and dump schemes can artificially inflate prices and hurt unsuspecting investors. Imagine what could happen if a government with insider information or the ability to influence the market got involved.
That's a scary thought. It's like the potential for insider trading on a massive scale.
Precisely. And then there's the concern about deregulation. A Trump administration might try to loosen regulations, claiming it's to promote innovation and free markets. However, this could also open the door to more scams, fraud, and market manipulation, ultimately harming investors.
It's a delicate balance, isn't it?
Yeah,
We need regulation to protect investors and ensure a fair and stable market,
yeah.
but too much interference or the wrong kind of regulation could stifle innovation and create new risks.
You've hit the nail on the head. It's a complex issue with no easy answers. It's something that investors need to pay close attention to as the political landscape evolves.
So with all these potential risks, how can we protect our retirement and personal assets in a world where cryptocurrency might be increasingly influenced by government policies, especially under a Trump administration?
That's a great question, and it leads us to some crucial strategies for safeguarding your investments in this uncertain landscape. One strategy is diversification. Don't put all your eggs in one basket, especially when it comes to something as volatile as cryptocurrency.
Diversification, that's a classic investment strategy, right? Don't just invest in one thing. Spread your risk across different asset classes.
Exactly. In the context of cryptocurrency, this means not going all in on Bitcoin or any single cryptocurrency.
Right.
Consider spreading your investments across a range of digital assets with different use cases, technologies, and risk profiles.
So maybe invest in some Bitcoin, some Ethereum, some stable coins, and even explore other up-and-coming cryptocurrencies with promising potential.
Precisely. And don't forget about traditional assets. Stocks, bonds, real estate, precious metals, these can provide a counterbalance to the volatility of cryptocurrency and offer a degree of stability to your overall portfolio.
Yeah, it's like having a safety net for your retirement savings. If one asset class takes a hit, the others can help cushion the blow.
Exactly. Another important strategy is to stay informed. Keep up with the latest news and developments in the cryptocurrency world, particularly regarding government policies and regulations.
So pay attention to what's happening in Washington and how it might impact the crypto market.
Absolutely. Knowledge is power, especially in a rapidly evolving landscape like this. The more you understand about the potential risks and opportunities, the better equipped you'll be to make informed decisions.
Okay, stay informed, diversify our investments. What else can we do to protect ourselves?
Consider seeking professional advice from a qualified financial advisor who specializes in cryptocurrency. They can help you develop a personalized investment strategy that aligns with your risk tolerance, retirement goals, and takes into account the potential impact of government policies.
That's a great point. It's like having a trusted guide to help you navigate the complexities of the crypto world. Speaking of complexities, what about taxes? We all know the IRS doesn't miss a beat when it comes to collecting their share.
Taxes are definitely something to keep in mind. The IRS treats cryptocurrency as property, not currency,
Okay.
which means any gains you make from buying, selling, or trading are subject to capital gains tax.
Capital gains tax, so it's like selling stocks or real estate.
Exactly. And just like with other investments, the tax rate depends on how long you've held the cryptocurrency. Short-term gains for assets held less than a year are taxed at your ordinary income tax rate. Long-term gains for assets held longer than a year are taxed at a lower rate.
Okay, so the longer you hold, the less you pay in taxes. But what if you use Bitcoin to buy something, like a cup of coffee? Do you have to pay taxes on that too?
Yes, even using cryptocurrency for purchases is considered a taxable event.
Oh, really?
The IRS sees it as if you sold your Bitcoin for US dollars and then used those dollars to buy the coffee.
Wow, that's a lot to keep track of. It seems like cryptocurrency taxes can get pretty complicated.
They definitely can be. That's why it's so important to keep accurate records of all your transactions. You need to track the date, amount, and fair market value of every purchase, sale, or trade.
So basically, keep meticulous records and maybe consult with a tax professional who understands cryptocurrency.
Exactly. It's better to be safe than sorry, especially when it comes to the IRS.
Okay, we've covered a lot of ground today. We've explored what cryptocurrency is, how it works, the potential risks and rewards, the impact of government involvement, and even the complexities of taxes. What's the one key takeaway you want our listeners to remember?
Cryptocurrency is a powerful and potentially transformative technology.
Yeah.
But it's still in its early stages, and the landscape is rapidly evolving.
Right.
Approach it with caution, do your research, understand the risks, and never invest more than you can afford to lose.
Great advice. And remember, your retirement is a long-term game. Don't let the hype or fear of missing out cloud your judgment.
Exactly. Make informed decisions that align with your financial goals and risk tolerance.
Well, it's been an incredible deep dive into the world of cryptocurrency, and a huge thank you to our expert for sharing your insights with us.
It's been my pleasure.
As we wrap up, here's a final thought for our listeners. How do you think the increasing adoption of cryptocurrency, coupled with potential government regulation, will reshape the future of finance and, more specifically, retirement planning? It's a question worth pondering as we navigate this uncharted territory. Until next time, keep learning, stay curious, and make informed decisions for your financial future.